Welcome to this presentation with SKAGEN Focus. It's myself, Jonas Edholm, and David Harris that is presenting as per usual. And as you can see on this picture, we find ourselves into a very polarized investment world. I think the question is if you ever seen a more polarized investment environment than you're seeing right now in global equity markets. Of course, in one hand, you have the AI-related stocks, the AI-related investment universe, if you will, that is focused upon, where there seem to be a different set of investment rules that aligns currently, and also very little focus on actual cash flow generation and on valuations, of course. So that's kind of interesting. And then on the other hand, you have the more traditional stocks connected to the real economy, if you will. Which in some cases are trading, especially in, like for instance in Europe, are trading at multiples you haven't seen since the global financial crisis in 2008, 2009. And this is clearly interesting, and this of course opens up interesting opportunities for a contrarian and value-based investor like ourselves. So we're going to take a look at that theme in this presentation, as well as the portfolio construction, the top 10 positions and new investment cases, and also how the fund has performed as of late. So we also want to remind you why SKAGEN Focus is not your average global fund. We are different in many ways, and of course, being a contrarian, value-based, price-driven investor is not something that you perhaps hear a lot about these days in the global fund industry. We are focusing also on global small and mid-cap stocks, and that is the average market cap stock in the fund is $5 billion. That is to be compared with the small mid-cap index, which is about $4 billion. We don't invest in anything that hasn't got a very deep or steep discount to its fair value that is estimated by us. And we estimate the fair value based on normalized or a steady state earnings power. We don't take growth into account 10 years or 20 years out into the future. We try to mold the company as it looks today, maybe 2 or 3, look out 2 or 3 years, combined with a very thorough analysis of the balance sheet. If there's any hidden assets, any assets the market might miss in terms of net cash assets, properties, or maybe cross holdings in Japan and Korea and so on. So we form all investment cases around these few parameters, if you will, and that results in a very unique type of structured global fund, current with very little US and a lot of exposure currently actually in Europe, as we will see later in the presentation.
We call ourselves contrarians, but what do we actually mean by that? For us, being contrarian is all about trying to identify different contrarian phenomena that constantly occur in different places within the market. And the key here is, of course, to find and capture value, undervaluation, attractive risk reward to bring into the fund. And we consciously try to seek for these contrarian opportunities. And just to give you some examples, some companies can be simply misunderstood for the reason of that they maybe are listed in one domicile, but have their operating assets somewhere completely else on the globe. We find a lot of market inefficiency among lower market cap and free float names. Smaller companies have less of a coverage compared to larger cap names, especially in the US, where the index is very concentrated. We find market inefficiencies among forgotten and ignored industries. We find this below the radar below the radar type of situations among spin-offs, for example, which we sometimes call the mother of all market inefficiencies, where you have one company spinning off a unit which is unknown to the market. Maybe many people hold the mother company because it's part of an index. They don't know what to do with the new shares being issued. They sell by default. There's a technical selling pressure. And we often are there in advance doing the work, have an opinion about what the fair value could be. And if the price is right, we strike. So there are different phenomena that we constantly monitor to try to capture this market inefficiency and find value. Our investment process is based upon cheapness and change, and this is done with a big dose of common sense. So nothing comes into the fund if it's not cheap enough, but we also need to be able to identify change, so catalysts that can drive a re-rating of the position, and we do this with a high degree of common sense. So focused on strong balance sheet and companies that are able to generate cash flow here and now. We do this together for more than 10 years and are one of the few standing value contrarian teams out there. Me and Jonas have been rewarded for our value investing performance, especially within small and mid cap globally. And we are doing this within SKAGEN, who is known for value investing and has been executing these type of strategies now for more than 30 years.
Yeah, so let's take a look at that polarized investment world that we described in the beginning of the presentation. And actually, right now, the annual spending of these so-called hyperscalers, which are building these AI data center infrastructure parks, basically, are actually equal to the whole amount of spending with all listed European companies, if you push forward to these points. And you'll see that it's interesting because increased capital spending seemingly is increasing stock valuations, or has been at least up to a certain point. This is, of course, not normal. When you have increased spending in something where the returns are extremely, not well understood or very uncertain, this usually means a declining stock price. But this hasn't been the case for these stocks that are connected to the AI universe lately. You have stocks like OpenAI, or stocks they're not even listed, but have $1.4 trillion in capital spending commitment, but currently have zero revenue. And how will this exactly get financed? I think that's a question that you should ask yourself when looking at this market, of course. And then very little focus on current cash flow generation, and zero reflection on valuations in terms of these transactions. And it's interesting, the cross holdings and the circular investment flows that are occurring now within these AI-related companies, these mega caps, that's something that the rest of the world is trying to avoid. In Japan and Korea, for instance, ironically, they're trying to unwind these type of holdings to increase stock valuations, which has been very successful, by the way. We've seen that in South Korea as of late. But that rule doesn't seem to apply in this world anymore, which is kind of strange. So it's a separate universe, basically. And then we have the rest of the entire equity market, or at least those stocks that are connected to the real economy, such as maybe construction, auto, consumer retailing, specific industrial segments, material sectors. In many cases, are trading at very low valuations, especially the small mid-cap stocks, at around 2 to 3 times normalized EBITDA, which is extremely low. This is especially true in Europe. We have a very large exposure to Europe, about 40% of the fund in these discounted investment cases. And also the tariffs have now been lifted, or the market is now seeing the actual tariff impact from the Trump administration, which is much lower than the impact initially thought back in March, when this was revealed on Liberation Day. So that has been a plus for this segment. And you've seen some re-rating, but the gap is still vast between these two investment worlds, of course. And looking at the equity markets from a bird's view, if you will, what exactly has this environment produced? Well, it has produced the following. You see the one on the one hand, you have the large mega cap stocks, which is about $91 trillion on aggregate. And you'll see that this environment has created a concentration of 25% of the top 10 companies is the market cap of that specific index now. So the rest, the 2,499 stocks of the rest are the 75%. On the other hand, you have the small mid-cap stocks, where the top 10 are 2.3%, which is, of course, the more normal structure for any benchmark. And that market cap is now about $25 trillion. And this gap has, of course, been widening. And we look at the valuations of these segments. You'll see that these top 10 stocks in the MSCI All Country World Index is now trading at about 60 times earnings, 30 times price book, and 33 times EV sales, which is, of course, and all these stocks are AI connected in some way, according to the equity market, of course. And then on the other hand, you have the value stocks that are a part of the small mid-cap universe, which is trading at very low multiples at about 12 to 13 times earnings, and the price book to almost equal to 1. So this is just how to show you how polarized this investment world has become out there. And then if we look at the performance between these two segments, the All Country World and the All Country World small mid-cap stocks, over time, since 95, the mid-cap stocks has actually outperformed the ACWI or the large mid-caps. This chart is not from 95, it's from 2009, but on a really long chart, that would be the case. This is just how to show you that from 2009 to 2022, these indices were following each other pretty well. But something happened in 2022, at the end of 2022, where it is completely disconnected. And if you look at the stock performances in these two segments, you'll see that the outperformance in MSCI All Country World, the large mid-caps versus the small caps, has completely exploded upwards. It's now about 30% percentage points higher than the SMID, which is an anomaly if you look at throughout history, actually, where small mid-caps usually is the better performing asset class over time. So this is kind of interesting backdrop, we think. And looking at the next slide, you'll see that we're showing you the discount between the small and mid-cap stocks and the large mid-cap stocks. And this discount is sitting on record levels with an 18% discount price to earnings. Usually small mid-caps are more expensive than large mid-caps. This is not the case currently. And the 45% discount in price book, which of course points to this normalization potential that you're seeing in between these two segments currently, or how polarized the investment environment has become, basically. And we also like to follow how, in this case, the US equity market, which of course is a very big part of the overall market cap, about 65% of the All Country World Index, how the equal weighted S&P 500 is performing versus the market cap weighted S&P 500. And in this case, you'll see that the very strong returns in S&P 500 has been driven by these top 10 or top 7 names, the so-called Magnificent Seven. The rest of the index is not keeping up. And this is pointing to a very poor market breadth in this upturn of the last few years, but especially now the last few months or 6 months since Liberation Day, if you will. So the rest of the stocks are doing nothing, while these top 7 stocks in the S&P 500 have done extremely well. So it's a sort of a red flag in terms of, or at least pointing to that you perhaps need a balance between these two segments when you construct your global portfolio. And also the result, of course, has been, if you look at value stocks versus growth stocks since 1975, when these indices start to produce, you'll see that value stocks now has given back basically all of their relative returns since 2007, from the mid 70s, basically, with this latest AI euphoria phase. Of course, the two other very, draconic time periods for value assets were QM Big Tech, almost for 10 years, and then the IT bubble, of course, in 2000, 2001. So this is how to show you how extreme this environment has become, but also the chance for normalization between these two segments, to be honest, moving into seeing in the 2 to 3 year time horizon.
All right, so this was a little bit on the operating environment. If we now zoom into the value spectrum where we operate, we just want to highlight that there's a broad spectrum in which we can identify undervaluation, and just to give you a few examples of that before we move into the fund. So there's different types of value. We talk about everything to the left from classic mean reversion, so situations where the sentiment has simply gone too far and the fundamentals are stronger than the market currently believes, and there's a normalization potential. Then we have underappreciated economic return type of value situations. So this is companies that are quietly generating strong returns, but haven't been recognized for it in the market yet, and we have plenty of those. Then we have cyclical value, where, of course, timing and discipline matter. Here we benefit from our focus on normalized earnings potential, trying to understand the cycle and be positioned ahead of it. We focus on strong balance sheet and good management teams. We have then restructuring and breakup type of value situations. So where you have, of course, catalysts being essential, where you can see corporate change, unlock value, crystallized value that the market is not pricing in. Then we have asset-backed type of value situations. This could be anything from hidden assets on the balance sheet to cross holdings or real estate holdings, for example, that can be crystallized or not discovered by the market for different reasons. We have a lot of those in Japan over the years, but now more recently in South Korea. And then we have value situations which we call discount on discount. So these are situations where we identify an asset that is undervalued in itself in the market, but we can access it through another layer of discount. So normally through a holding company where we have then two layers of discounts, a discount of discount. So just to give you a sense of the different ways we can identify undervaluation, that we also try to diversify among those. And in front of you, you have different examples in the portfolio. And of course, one company can take more of these boxes, the more the better, but just to show you the breadth of the portfolio, some of the holdings. If we zoom in and take a look at some of the bigger names in the portfolio to give you a little bit more flavor. We can start with Methanex.
Yes, we want to show you a few portfolio holdings in more detail, and starting with Methanex, which is a top 10 position in the fund. It's essentially been in the fund for perhaps a number of years now, but now the investment case we think really are starting to form. And this is one of the largest producers of methanol globally, which is used for production of industrial chemicals and also in fuel for ships and so on to a much more larger extent, since it's considered to be more environmental friendly. The methanol market has been in balance over the last few years, and the price hasn't done much either on the upside or the downside. But on a steady state earnings power, with Methanex acquiring the OCI assets and also have constructed a new plant for the Gais material for producing methanol. We think this is a classic economic return value case where the free cash flow yield on current methanol pricing seems to be around 15% in 2026, which is got extremely high free cash flow yield. That is the free cash flow in relation to the market cap of this stock. At the same time, we think capital allocation catalysts are shaping in Methanex, since the cash flow is so high in terms of share buybacks and so on. They're going to pay down debt following the acquisition. So we see very positively on Methanex heading into next year, basically.
Yeah, and then we have KCC in South Korea, which is a new top 10 position in the fund. And KCC is a somewhat under the radar name, very little analyst coverage whatsoever. This company operates within construction materials, and it has been exposed to end market that has struggled over the last years. It's mostly exposed to shipbuilding, automotive, and construction in South Korea, where we see a normalization, especially within shipbuilding. We see an end market that is really going through a revival. As you can see, the company is in itself is trading quite inexpensive at 4x EBITDA. But what the market is really missing here is that this is a conglomerate. KCC, as you can see, has a market cap of $2.7 billion. KCC owns a stake in another South Korean company, a construction company called Samsung C&T. It owns 10% of that company, and that stake alone is worth as much as the market cap, the entire market cap of KCC. On top of that, it has other cross holdings, direct and indirect, which additionally adds significantly to that enterprise value. And then on top of it, the company owns 17% of its own shares. It has been buying back stocks, and of course, now with the pressure within the Value Up program, we see increased pressure to monetize this somehow, to cancel treasury shares and to give back money to shareholders. So plenty of catalysts, and then a core business that is normalizing, we think is very attractive, a top 10 position in the fund.
Yeah, we talked about our preference for looking at spin-off situations, and this is a classic spin-off situation. Amovio, listed in Germany, recently was spun off from Continental, the German auto parts maker, and this is an auto parts maker too, with focus on sensors, brakes, automated driving systems, and so on. And when it dropped down into the equity market, we've done our homework, and we felt it was worth a lot more than the actual initial price that it was trading on. It started trading at about 2 times enterprise value to EBITDA, which is extremely low on depressed earnings power. We think this company might go from 2 to 4% EBIT margin to maybe the average in the sector over time, which points to a very interesting earnings growth profile. And valuation should probably be at least 4 or 5 times EV/EBITDA for an asset like this. So we saw at least a 60% upside to begin with Amovio. This has only started trading for a month back or so, which is still it's been performing strongly following strong earnings just the other day. But still we see a very good upside in Amovio from here, and with about 3% of the fund now, actually.
Okay, and then let's move over to some important themes that we want to highlight in relation to the portfolio. Maybe first we can start with precious metals and highlight our silver bullets within the portfolio. I think many people are aware of that there's been a very strong rally among precious metals. Firstly, gold that took off, of course, driven by a mix of different things, the shifts in reserve among central banks, inflation hedging, and of course, geopolitical tension. But silver has been catching up, and silver has this dual aspect within the metal. It's both a storage of value, so to speak, like gold, but it also has an industrial part of it demands. And of course, as the demand has now stabilized and improved, that has also led to the re-rating and catching up of silver, which we think is interesting. We have 2 positions in the portfolio during the year that has been exposed to this theme, primarily Silver Corp in the beginning. It was initiated in the beginning of the year, but has been closed at price target now following the strong rally, where Silver Corp, of course, benefited from the strong rally in silver. But we still have Aya Gold and Silver in the portfolio, and this is a little bit of a special below the radar situation where you have a asset which has been a pure silver asset that has been restructured by the company's new management team and is now producing attractive cash flow. But what we think the market is missing is that Aya also owns another asset that it's currently developing, and a recent economic study shows that the value of that asset alone conservatively exceeds the current market cap of Aya. So we think this is an attractive story still in the portfolio.
Yes, we've also been following the protectionistic measures from the European Union as of late, which has developed into the European Steel Shield, which perhaps a few investors might have missed, but it was introduced and will probably be realized in mid-2026. So they're basically halving the quota for imports of steel, both stainless steel and traditional steel, into Europe. And this will probably create a new environment for the steel makers in Europe, which has been loss-making for the last 2 or 3 years, basically. It's been a very tough environment, low capacity utilization, and so on. And this might now change also with Europe investing in the defense industry and so on, is moving forward rapidly. So we think this might form into a normalization potentially of the earnings power of these assets. We have assets that are connected to this theme in the portfolio, Acerinox being one, a Spanish-listed stainless steel maker with huge, large operations in the US, but also a loss-making European operation, which might turn into black, which would be very beneficial for that name and also propel a revaluation. Befesa is another name in the portfolio, German-listed waste recycling, steel waste recycling stock, which essentially is taking care of the waste that these steel factories generate and produce, and is transformed into new metals that they sell. So that's a sort of the below the radar beneficiary of this environment as well, we think. Private equity recently taking a stake in Befesa at 5%, Triton, an interesting thing with that name as well.
Yes, and then of course we have South Korea being a major driver within the portfolio this year, and a very attractive theme for us that we have been discussing over the year because of the exceptional opportunities within this part of the market. We've seen continued progress here, supported of course from the government's Value Up program. And for those of you who have listened to us over the years know that we see similarities here as to what we saw in Japan for more than 10 years ago, where the government was pushing for companies to improve governance and to increase disclosure and shareholder returns. And we see the same type of pattern here being initiated. And of course, in Japan, we saw this substantial re-rating that followed, and we believe that we're on to a similar pattern here in South Korea. We currently have more than 20% of the fund being exposed to this region in a diversified group of names. South Korea has been one of the most strongest markets globally year to date. Value Up program is, of course, a massive driver, but also political stability and easing of tariff risks that we have seen over the year. Yeah, this chart just highlights the different positions we had within the financial space within Korea. For those of you who know us for some years, we had a big position among top 10 in KB Financial, which was the bigger regional bank here, high quality name, and it was the pioneer, especially within the Value Up program reforms. It was the first bank to buy back shares and also to cancel treasury shares. That position eventually reached our price target, so we closed to that target and then rotated into lagging peers that have more catalysts ahead of them and trade still at a substantial discount to fair value, we believe. So still plenty of opportunities in South Korea and still a very big part of the portfolio given the exceptional opportunities.
Yeah, we also want to highlight that we had a takeover or a buyout offer in the portfolio received on our asset in Comerica, which is a regional bank in the US. We were probably one of the few funds that held this asset. It's not considered very well managed. It's an asset that was trading very cheaply on book values if you did certain adjustments, which I think this particular buyer, Fifth Third, saw when they looked at Comerica. And people have been waiting for the activity to pick up in M&A in the US regional bank area. Now that seems to be happening. We were happy to get a 17% premium on the asset in Comerica from Fifth Third in this transaction. And it actually went into our price target range, and we subsequently sold that, exited that asset right after the takeover offer from Fifth Third. It was a 3.5% position in the fund, so a nice contribution there to fund performance.
Yeah, and then maybe some slides on how to think about the fund in relation to portfolio construction if you compare us to other global funds that you can have in your portfolio. This chart is from a third party that compares different global funds to each other, and I think it's without doubt that our price-driven strategy really stands out on this chart when we're compared to almost 400 other global active managers. We are absolutely in the bottom percentile when it comes to how the fund in aggregate is valued. So you see price to earning, absolute bottom percentile versus other funds. We are, I believe, the cheapest fund out there when it comes to price to book, and our emphasis on solid balance sheet, free cash flow generation, and of course, ability to increase shareholder returns also shines through if you see how we are positioned versus other managers when it comes to our dividend yield and the higher percentile there. If you look at our exposure and compare it to other active managers, which this third party did, you can see that we stand out and are more diversified when it comes to our country allocation, as opposed to how most other people are positioned. Most active managers, if you see at the mid-term column, you see most of them, on average, 55% are exposed to the US, whereas this fund has right below 10% exposure to the US currently. And this is reflecting the fact that we generally struggle with finding attractively priced stocks in this region and find much more compelling opportunities elsewhere. Like, for example, in South Korea, as you can see on the first column at the top there, the fund has 23% at the end of October exposed to South Korea. Just to show you how a mandate like this can fit into a broader global portfolio to maybe diversify some of these concentration risks we see in the market, and a fund that focuses on something else than AI and growth opportunities in the US. If you take one step back and look at it from a maybe more regional basis, you see that SKAGEN Focus has 40% exposure to Europe. As Jonas alluded to, we find a lot of opportunities here in the midterm with very cheaply priced, especially small and mid-cap stocks. And you can see this exposure in relation to the ACWI or ACWI for small and mid-caps, which still is very much concentrated within the US and not as much exposure to either Europe or the rest of the world.
Yes, and we have this chart showing you a few stocks that hit our price targets in the fund. As you know, we're very disciplined in the fund. We're exiting any stock that hit our price target. We very rarely revise our price targets from the original investment thesis. And we showed you how Comerica did go to its price target, and also Silvercorp. Here we have three other assets. SKAGEN Technology, a semiconductor machinery producer in Korea, hit our price target. Hyukogo Bank, a regional bank, initiated in 2023, hit our price target following a 60% upturn in the equity price. And also Hanwha Corp, Hanwha Group, which is a defense conglomerate in Korea, did re-rate sharply as this corporate governance measures really kicked in South Korea and lowered the discount in these investment conglomerates in the country. So in total, 9 positions hitting price target this year in the fund. And looking at the winners, we mentioned SKAGEN Technology on the slide before, which is the best performer this year. Hanwha also being strong. If you look at the top 10 positions, top contributing positions this year, I'd say that out of the top 10, we probably have 5 or 6 from South Korea, considering our exposure and how strong that equity market has been. Ayvens is also have been very strong. It's a bank holding car leasing company in France, which is a combination of 2 other smaller assets, and the market has completely missed the earnings power of these 2 assets combined, which is now starting to reflect. It's still a top 10 position. And on the tractor side, we have Interfor, which has left the fund. It's a lumber producer, which we sort of have given up on at this moment. It's exited the fund. Metanex not being strong this year, but we have increased the position, as we mentioned. We have increased conviction in that name heading into 26. And we also have Nexity, which is a French commercial apartment producer, which has been quite weak, not because of the French turmoil, and the political turmoil hasn't helped that particular stock and the sentiment and so on. So it's a smaller position in the fund currently, which has been a detractor this year. And looking at the net annual returns, you'll see that we compare ourselves versus the ACWI and the ACWI SMID, and 2022, 23 being strong years for the fund. Last year was very tough when it comes to, of course, you had the AI related movement starting really move in 24. And we didn't keep up with that, although producing a decent absolute performance. In 25, we have outperformed the all country world SMID index. This is as of last October, but lagging the ACWI somewhat as per that date. And on a longer horizon, you'll see that over a 5-year horizon, this is versus the small mid-cap index, which is probably the best comparison for the fund, considering our market cap average in the fund is about 5 billion, and it's about 4 billion in the small mid-cap index, ACWI. We have been executing on a pretty decent performance versus that index over a 5-year period, as you can see here.
Yeah, then maybe taking a look at the portfolio composition. SKAGEN Focus can have up to 50 positions. We currently have 48 positions. The average market cap in the fund is currently $5 billion. So clear focus on small and mid-cap names in the portfolio. We have a pretty decent average upside towards our price target. So really, you're buying into a product at a steep discount, 80% weighted upside towards our price target, and a fresh portfolio that goes back to this price discipline that Jonas spoke about, where we really close positions at price target. When they trade at fair value, we close positions if we see violations in the investment thesis, and try to keep a fresh portfolio for our unit holders with an attractive upside towards fair value. If you take a look at how the fund is valued, simplistically speaking, maybe compared ACWI or ACWI SMID, you see that it trades at a steep discount of 9 times price earning, as opposed to ACWI at 19 and SMID almost 17. And the same goes for price to book valuation. When you look at the fund in aggregate, you have a steep discount to any type of index out there. Taking a closer look at the top 10 positions in the fund, which constitutes 34% of the entire fund, you have a attractive upside and a well-diversified basket of names, as opposed to how the index is concentrated around one specific theme. You see different type of dryers that build up this group of companies, a mix of names. We've covered most of them: Metanex, Avens, KCC, Befesa. Maybe also worth to highlight Hyundai Mobis, which is a South Korean automotive supplier, which is now heading towards an attractive midterm environment, we believe. And on top of that, it also adds as a holding company, as it's the holding company for Hyundai Motors, also fitting into this value up program. So in aggregate, a diversified portfolio, which really fits as a building block if you want a diversified, otherwise a global index portfolio, which is very exposed to one specific theme and one specific region.
Yes, so we think we're pretty unique in what we're trying to do in the fund, with using the cheapness, change, and common sense, being contrarian, price-driven value investors. And these deeply polarized global equity markets are really creating an interesting environment, and we think an interesting opportunity for us as contrarian investors over 2 to 3 years, as the vast area of the global equity markets are pretty ignored currently. So we're being small in the US, about 10% only, and a large exposure to European assets. We mentioned a few in this presentation, about 40%. And of course, this gap between small mid-cap assets and large mid-cap assets is reflected in our 80% upside to our price targets in the fund, which is quite elevated, actually. So I think that's what we had today. So I think we'll stop there.
Supert. Da skal jeg stoppe opptaket, og så